Hello, and welcome to another Quick Byte presentation brought to you by the Economic Alliance of Okanagan County. I'm Mason Duke, and this week we'll be discussing gross and net profit. Let's begin with a brief review of what was covered in last month's episode, as it will be important for today's topic. If you haven't seen that episode, you can find it on our Facebook page or YouTube channel. The two key concepts we explored were revenue and costs. Revenue is the money a business makes from sales. It can be determined for each sales unit, that is, the different items or services offered, and in aggregate. Revenue is calculated by the simple equation price times quantity. Costs, or expenses, are the money a business pays out in order to operate. They are either directly or indirectly related to sales, and remain fixed or vary based on sales amounts. To simplify things, they can be roughly grouped into cost of goods sold, which is directly related to sales and varies with them, and overhead, which has an indirect association with sales and is often fixed. If revenue is the money a business makes, and costs are the money it spends, then profit is the positive difference between the two. It comes in two primary kinds, gross profit and net profit. Gross profit can be determined by taking the revenue and subtracting the cost of goods sold. For example, let's say you spend $2 on ingredients and packaging to sell a muffin for $5. If you sell 5 muffins, you're making $25 in revenue, but spending $10 in cost of goods sold. So your gross profit comes out to $15. Like revenue, gross profit can be analyzed for each individual sales unit. If you're selling donuts as well as muffins, they'll have different revenues and costs of goods sold, meaning they'll also have different levels of gross profit. Determining the gross profit of your sales units allows you to track popularity and pricing, ensuring that you're actually making money on everything that you sell. Net profit can then be calculated by subtracting overhead expenses from your gross profit. This will need to be the total gross profit from all of your sales units, so be sure you're adding up the gross profit from each one before you subtract out the overhead. To continue the baking example, you'll want to add up your gross profits from the donuts and the muffins, and then subtract out all the costs that aren't directly related to their production and sale, things like rent, insurance, and utilities. In other words, net profit takes the gross profit you're making from sales and then accounts for all the remaining administrative expenses to see if the business as a whole is profitable, and if so, by how much. It's also what a business will be taxed from, as it is the source of the owner's income. Net profit that doesn't go towards taxes or the owner's draw can be safely invested into the business to upgrade and expand. Federal income tax rates change regularly and vary by annual income as well as marital status. The graphic here shows tax rates as of 2023 for a single person making $58,000 a year. Small business owners are also responsible for paying self-employment tax, which currently hovers at around 15%. The two of these together only constitute the bare minimum, as businesses will be responsible for additional taxes if they employ staff or operate in certain industries and areas. It's often smart for business owners to estimate how much they will owe in taxes in advance and keep the money in a separate bank account, so that it's available come tax season and isn't accidentally used for some other purpose. For more specific tax information and advice, consult a business tax professional like a CPA. When considering costs and profits, businesses can perform what's called a break-even analysis, assessing the point at which revenue catches up to expenses and pure profit can result. Owners can identify break-even points on a monthly and yearly basis, finding out how long it typically takes them to break even. The Small Business Administration has additional information on break-even analysis available on their website, as well as a free calculator to determine your own break-even point. That's it for this month's Quick Byte episode. Now that we have a basic understanding of costs, revenue, and profit, next month we'll wrap up this 3-part series by looking at 3 essential financial documents that allow you to track the success of your enterprise. We'll cover what they look like, how they're used, and even provide some templates to help you get started. See you then.